We continue with our discussion on relative valuations, which is in Unit 3 of equity valuation. And now we are going to introduce the first ratio that is important for our understanding, which is basically the price to earnings ratio or the PE ratio. Once again, a little bit about PE ratio has already been covered in one of our earlier courses and in financial management. And hence, this is going to be a broad recap of that and then extension on essentially what really drives relative valuations and how do you really look at relative valuations in that context, right? So let's first do a quick recap of what do we mean by the price to earnings ratio. This is one of the most commonly used metric worldwide in terms of comparing companies in terms of relative valuations. And what this basically means is price to earnings ratio. In other words, you're taking the share price of the company, commonly known as market price of the share, and divided by the earnings per share of the company, commonly known as EPS. MPS by EPS is what is going to give you your price to earnings ratio, right? That's the calculation of what do we mean by the price to earnings ratio. Let's try and understand the interpretation of what this means. So what is earnings per share for the company? What do we mean by EPS? EPS is basically the net profit of the company divided by the number of shares of the company, right? What does this mean? If a company has a net profit of 100 crore and a total number of shares of 10 crore, right? Then the EPS is rupees 10, right? EPS is rupees 10. What does that mean? If you buy one share of the company, if you buy one share of the company as a shareholder, you are entitled to 10 rupees of the profit share in the company, right? Out of the 100 crore, this 100 crore will be distributed as 10 rupees into 10 crore shares for all the shareholders. So if you hold two shares, then your share is equal to 2 into 10. If you hold three, it's 3 into 10. For every share, you're basically getting earnings entitlement. Why do I use the term entitlement? Because it is not necessary that the company pays you this earning. It is not necessary. The company is just saying that you have a shareholding in this particular proportion, and because you have a shareholding in this particular proportion, you are the owner of that amount of earnings. The company may choose to give it as dividend. The company may not choose to give it as dividends. Correct? That's how you calculate earnings per share of a company. Now, you take the market price and you divide it by the earnings per share. What is the interpretation of that number? So let's assume the company's share price is 200. That's the market price of the share. And net profit is 10 crore and number of shares is 1 crore. So what is the EPS? EPS is total net profit divided by number of shares. So that's 10. And what do we calculate as the PE ratio? We calculate 20. What does this mean? It means you are willing to pay rupees 20 for rupees 1 worth of earnings in the company or earnings entitlement in the company, right? Now, why would you pay 20 for one? Is because this one will keep coming every year as long as you hold the company's stock, right? So you're paying 20 rupees for an earnings worth of 1 rupee this year. Next year, that might be different. Basically, P ratio denotes the number of rupees you're willing to pay per rupee of earnings of the company, right? If the number was 300 by 10, then you would have paid 30 rupees for 10 for 1 rupee of earning or 300 rupees for 10 rupees of earnings, right? Now, in relative valuations, remember we say the companies are similar. If the companies are similar, then for the same 1 rupee of earning or for the same 10 rupees worth of EPS, why would you pay 300? You would want to pay 200. So if everything else is the same, you would want to pay lesser amount for the same amount of earnings entitlement in the company. Correct? That makes sense. So it's a simple ratio. If you have a benchmark for comparison, if P for one company is 10 and that for company 2 is 5, company B is 5, in the first case, you're paying 10 rupees for 1 rupee of earnings in the company. The second case, you're paying 5 rupees for a similar share of earnings in the company. Now, lesser the better, correct? Lesser the better, because effectively you are paying less to get the same amount of share. right? That's the idea. But it assumes that the companies that are being used are similar in risk profile, similar in size, similar in business, similar in the way they conduct their business, similar in client concentration, similar in their pricing power, similar in everything. In real life, this similarity may or may not be available, right? So in real life, saying that P ratio is lesser the better is probably going to be an oversimplification. We are going to look at this example and understand in the absence of any information, lower PE is better. So typically you will read texts that says buy stocks with PE of less than 20, sell stocks with PE of more than 40 or 50. However, this most of the times is an oversimplification. Theoretically speaking, this makes sense, but in real life, there are factors which result in what drives this valuation of companies. We'll try and understand them as we go along, right? There's another way to kind of consider how do we calculate the PE ratio. So remember we said share price of the company divided by earnings per share of the company. If we multiply the numerator with number of shares and denominator with number of shares, we can do that, right? So the numerator becomes share price into number of shares, which is nothing but the market capitalization of the company. The denominator becomes earnings per share into number of shares, which is nothing but net profit of the company. Remember, EPS was calculated as net profit divided by number of shares. So if I take number of shares here and multiply with the EPS, I will get net profit. So I can directly calculate the market capitalization and net profit of a company to arrive at what is going to be the price to earnings ratio of a particular company. We can try and use this exercise as well. We can try and understand and take a look at this exercise as well while we do this calculation, right? So that's broadly how do you look at price to earnings ratio. Let's try and calculate this for Infosys, right? Let's try and calculate this for Infosys. If we remember from our previous section, we said trailing EPS for Infosys for the period of January to December 2016 is 62.77 rupees. So we have the EPS that's 62.77. All we need to find out is what is the market price of the Infosys share today, and we should be able to calculate what is the trailing estimate. So to find the market price of Infosys, we go to the website of NSE and we click on NSE and we get 1023 as the number. So I can just replace 1023 as the number here. 1023 divided by 62.77 is what is going to give me the trailing PE ratio, right? So I can write this down here. We'll do the calculations in a bit. Trailing price to earnings is 1023 divided by 62.77, right? And that number would basically give us what's the PE ratio of the company. So we can move to our Excel file for Infosys. If you remember, we have done a DCF model for Infosys and we can just add the tabs there. So we've just added a relative valuation tab and the current price is 1023. The TTM EPS is, as we just saw, effectively equal to 62.77. So TTM price to earnings ratio is going to be equal to A by B, correct? That's what the number we get. So that's what the number we get, and we can just do this, right? So that's the first calculation that we get in terms of trailing PE ratio for Infosys. Can I get a forward PE ratio as well? Let's say I want to calculate the forward PE ratio with 2018 earnings, right? With 2018 earnings. So do we have expected 2018 net profit here? Do we have expected 2018 net profit on the P&L? If we go to 2018, we have projected a net profit for 2018, right? That's the expected number as per our calculations. We could be right or wrong, but as per our calculations, this is the expected net profit. I am trying to use the other formula now. Let's try and find out what is the market capitalization of Infosys today in rupees crore. Remember both of these, this is rupees crore, and this is also going to be rupees crore, what is the market capitalization of Infosys? For that, I can simply do a Google search of market capitalization of Infosys, and you will find that the market capitalization of Infosys is 2.34 trillion. 2.34 trillion would basically mean 234,000 crore rupees. 2,34,000 crore rupees. So 2.34 trillion is 2340 billion, and 1 billion is 100 crore. So that's how we get this number, correct? Now, can I find the forward price to earnings ratio? That's the market capitalization divided by the net profit number. And that number comes as 19.3, right? Now, usually what would happen is that your forward earnings are higher if the company is growing. In this case, what's happening, or what seems to be happening, is we have assumed a dip here, right? We have assumed a dip here. If for some reason we assume that there is an increase in growth, so let's say in the assumptions we go and we say that in 2018 the rupee dollar rate might become 71, just for argument's sake, right? What that would do is your PNL would show a big increase. 14,85895 will be the profit for that year. When you go for relative valuations, if the company is growing, your forward PE ratio should be lower. Why should your forward PE ratio should be lower? Because when you're dividing the same price by trailing 12-month EPS or FY18 expected EPS, here the denominator is bigger if the company is growing, and hence the forward PE ratio might become smaller for the company. That's basically how you calculate the PE ratio for a particular company like Infosys. Now, to extend our understanding, what is important is that we understand the distribution of some of this data, right? If we look at a set of companies on the Nifty or NSE and try and look at how does the trailing PE ratio for them work, we find that something like NTPC, which is in power sector, works at around 17-18. BHEL is negative. What does negative mean? Price can never be negative, so the earnings are negative, correct? It's making losses. Asian Paints is around 55, Nestle is around 100, HUL is around 50, Symphony is around 75 or 80, Relaxo Footwear is around 50 approximately. Hero MotoCorp is 20, Maruti is about 35, Ultratech is about 45, Apollo Hospitals 50, Infosys we just calculated is around 16, 17. Idea Cellular is lesser, that's about 12. SAIL is negative. Hindalco we don't see here because that was an abnormally high number, that's around 800. Page Industries 70, Eicher Motors 55. Now we see that we cannot compare PE ratios across industries, but the question that comes to our mind is how high is actually considered high, or when do we say it is overvalued, right? Why is something trading at 15 and the other sector trading at 55? I mean, what's the range of dispersion that we are getting, right? So the first thing we need to try and answer here is what is driving this PE ratio, right? What are the key drivers of this price to earnings ratio is what we need to try and identify. What creates this distribution of PE ratio is what we have to try and identify. Now, when you look at PE ratio, in terms of identification, let's recall our example of paying 200 rupees for an EPS of 10. Let's assume for a minute that the company is in a zero growth scenario. If the company is in a zero growth scenario, then in the first year you're going to get an EPS of 10, second year EPS of 10, third year EPS of 10, fourth year EPS of 10. This is going to take you 20 years to recover your initial money. In other words, the payback period is 20 years. Assuming zero growth, the payback period is 20 years. So that's the PE ratio. That's what we saw was the PE ratio, right? This assumes zero growth, right? Now imagine that a company grows faster. So it's 10 and this is 12 and then you see 15 and then you see 20, which basically means you're going to get your money faster. If you're going to get your money faster, you might be willing to pay more because you might still get a payback period that is shorter in this case, correct? And so while here you do 200 divided by 10 and that gives you a P ratio of 20, here you do 300 divided by 10 and that gives you a P ratio of 30, it is possible that you choose to invest in the second company because of the fact that there is growth, right? So one of the key drivers is going to be what is the sector or what is the industry, what kind of opportunity exists in that sector, what kind of possibility of growth exists in that sector, and hence what will the company do with this particular growth? How quickly can it return your money? The faster the chances of the company returning your money, the more in demand the stock would be, and consequently, the more relevant this data point would be, right? So that's basically the first crux or important data point that comes to us in terms of understanding what is the driver of the PE ratio. The second driver that you will see will be with respect to things like how long are you willing to give your money to a company? So the question is how long payback period can you agree to, right? Now that depends on what kind of faith or trust you have in the company that it will survive that period. So if you're paying 500 rupees for a company that's giving you 10 each year, you're effectively saying that I expect the company to survive for 50 years. Nothing will happen to this business over a 50-year period. But on the contrary, if you're paying 150 rupees for something that is giving you 15, 15, 15, you're saying I only trust the company with my money for 10 years, right? So effectively, the first data point we saw was growth. The second data point we are going to look at what drives the valuation of companies is the stability. What kind of stability the company could exist or expect in this entire spectrum of things. What is the kind of stability you expect the business to survive for a period of time? You know that FMCG companies like Hindustan Unilever are going to survive because there is going to be a market for soaps, there is going to be a market for toothpastes. You will always have a scenario where the company operates on lower debt, and basically based on that you can make a broader case that the company is going to survive for 50 years. But that's not so true for a company like Tata Steel. You may not be sure that given the kind of vagaries or the kind of volatility that exists in markets like steel, whether it'll exist in the same form or fashion after 10 years. It might have to sell a company that it owns. It might already have to, it's for example, looking to sell Chorus at this point of time, right? That's basically that it doesn't exist in the same form or fashion after 10 years. There's no guarantee in certain sectors. So anywhere you find stability and anywhere you find growth, your P ratio is going to be bigger. Let's take an example. Look at the opportunity size in the sector, and that's where sector analysis becomes a very important part of valuation. If the opportunity size, let's look at the healthcare sector. When you look at hospital beds per 10,000 population, India is abysmally low as compared to a lot of countries like Argentina, Brazil, China, Malaysia, and Thailand. Forget the developed world. Even in the underdeveloped or the, let's say, developing world, we are significantly lower. The world average is 30, which means there is a huge opportunity for companies to kind of work in this. So healthcare sector should see a huge growth in the time to come. Healthcare sector should possibly see a huge opportunity. What is important is to understand what hospitals might be able to do that. So you would typically assume that this is a scale business and the larger players are more likely to kind of be there. And that is precisely why you see this with Apollo hospitals. You're willing to give your money for 50 years because you expect a huge growth rate. And because of that huge growth rate or a huge opportunity size, you expect Apollo to be one of the top players in that market to be able to capitalize on that opportunity. And hence, you look and say that the valuation of hospitals is probably higher in that sector. Look at another opportunity in terms of consumer durables in urban India. Television is practically covered by most of the households, but refrigerator, air coolers, washing machine, and air conditioners have significantly lower penetration. These numbers are significantly high for other countries like China. Right now, you would possibly believe, for example, air conditioners, you would believe that that's possibly because of power supply disruptions in India, and that's possibly because of affordability as a market in India. Affordability keeps improving over a period of time. As more number of people get jobs, more number of people work, their salaries increase, affordability improves, and power supply will also get solved at some point of time in the future. At which point this number will explode to something like 50, 60%, similar to what television penetration levels are in households, right? Now, if that is the opportunity size, you try and find out, for example, in air coolers, which has 17% penetration, who's the leader in the organized segment? That's Symphony Limited. So you find because they are the leaders in the organized segment and they are the only players whose name resonates in the air cooler segment, primarily Symphony trades at a multiple of 75 times purely because of the opportunity size and the fact that they could participate in this growth, right? Then you look at companies that are in specific markets and they've executed this plan well. So one of our favorites in a lot of the topics we've discussed, Royal Enfield. We know that in 2010, Royal Enfield sold 50,000 bikes a year. They sold 300,000 in 2014. They sold 600,000 in 2016, and that number continues to grow now. So that's effectively a 12 times jump over a 6-year period in volumes. And not only in volumes, price per bike, which used to be about 80,000 in 2009, has now actually in 2016 gone above 125,000, right? So there is a 12 times jump in the volume, there is a 1.5 times jump in the price, and not only was there the opportunity, they still sell about 7 lakh bikes a year out of 1 crore bikes that get sold in India every year. Out of this 1 crore, nearly 50% or 50 lakh bikes get sold by Hero, right? So if you go back to this chart and look at Hero MotoCorp, they are already the market leader, but they are the market leader in a saturated market of 1 crore bikes. That market doesn't grow at the same rate as Eicher Motors, which is into premium bikes. And even though their growth is significant, they still have 7% of total market, right? Which can grow dramatically. For example, in India, in the last 5 years, we have sold about 5 crore bikes. Even if 2% of these look for an upgradation every year to a premium bike, that 2% will be 10 lakh bikes, which is much bigger than the number that Eicher Motors sells today. So while they are both in the two-wheeler segment, Hero MotoCorp is in the less than 250cc segment, Eicher Motors is in the greater than 250cc segment, and this is a prime example of how all other things are not equal in the market. That's seemingly similar companies, right? That's basically why you see opportunity and growth, and you can link it to financial statements where operating margins, return on capital employed, and return on equity, all the ratios have jumped for this particular company, just showing us that they are good in executing that opportunity. And that's the reason they trade at a price to earnings ratio of 50, right? So just to summarize, the safer a business, the higher the valuation it will command, higher the growth, higher the PE it will command, right? So basically companies like HUL, ITC have PE multiples which are much higher than, let's say, steel companies, which will typically show you lower PE ratios or volatile PE ratios. High growth companies will command higher PE ratios. Anywhere where you have a big opportunity and the company can take advantage of that opportunity, you will probably see that price to earnings ratio will appear to be much, much better and much, much higher, right? That's what drives valuation. That's what drives PE ratios. And that's it in this particular section. As we close the section, we just kind of look at a couple of questions. What do we mean by the price to earnings ratio? And what do you think are the key drivers of price to earnings ratio? Thank you.